I've gotten good at not talking during that part. All right, so we're going to start off with chapter 1. It's a good place to start as any, I suppose. And our focus in this chapter is going to basically be similar to what if you took my accounting 111 class, kind of talking about the profession, various important aspects of the FASB, what they do, the conceptual framework, and stuff like that. So it's going to be a kind of more of an informative, but also hopefully reiterative information that I'm going to be providing you. So this graphic's pretty cool, I guess. When I was looking at it earlier, bottom line is that accountants are more than just what we've been doing in accounting 111 and 112. We're just counting, calculating, and putting journal entries. The critical thinking aspect of an accountant is very critical. We have to make decisions about areas that are not quite clear cut. Okay. We need to make sure the information and the decisions that we make based on certain circumstances are communicated to our decision makers for them to make the decision. So it's a very important role that we accountants play. And for those of you who are worried about AI taking over, the only AI can't take over every aspect of accounting. In fact, not even a lot of it. Accountants aren't going anywhere, because you can program a computer to think and stuff with AI that they're doing. But how does an AI consider anything other than what it was given to it to look for? Like, I've been doing research on AI, and I realized that a lot of AI uses Wikipedia as its sources. So what does that do to the credibility of AI? Well, it takes it down a bit. So that's what we want to avoid when accountants are making judgments. We need to make sure we're accounting for everything. So as much as possible, obviously. All right. Here's our primary focus. Again, we're looking at our external users. Internal users are focused on managerial and cost accounting stuff. Instead of taking managerial accounting, although just the knowledge of it existing is really all you need for this course. We're focused on making sure and protecting our investors and our creditors. Excuse me. So financial accounting, we have our financial statements, and we have our big four here: balance sheet, income statement, statement of cash flows, and the statement of shareholders' equity. If you took 111 or 211, we talked a good chunk about sole proprietors. Like I said before, but if you're new, we're not touching sole proprietors pretty much from here on out until you get into some kind of tax classes where they have to start dealing with other entities. Our sole focus now is going to be looking at C corporations. So these are the four ones that we're going to be focusing on, which instead of owner's equity is shareholders' equity. This is the information, where it comes from, how we provide it and everything. So we have all these different types of entities. And then the users of the financial information, you have all of them there. I'll let you pause the video if you'd like to look at that, but I'm going to go ahead and move on. I want to try and keep these videos to 30, 35 minutes at most. Capital markets is how we are able to allocate resources efficiently. The point of it is that if people have capital or money that they want to invest in and people need an investment, that's what the capital markets are there for, is to help you do that. We need to consider that. We need to think about that. It's something that we need to make sure that we have at our fingertips, so that as we try and do our capital projects, as well as other things too, mostly capital projects, but we can get that money either through borrowing or through ownership to the investors. So why do they do that? Pretty much investors and creditors are looking for a return. They want money back. Okay, they want to loan you the money and then get some extra money on top of that. So one of the things that we look at, or two of them that are listed here, is rate of return and risk. Okay. Basically, our rate of return needs to mirror what our risk is. So if something is extremely risky, we should expect a higher rate of return than what the average market is giving. versus something that's extremely safe would likely give a lower amount of interest. So if you've ever invested money into into a company or something, or if you've done a 401k or a Roth IRA or something like that, typically when you first set it up, they're going to say, what's your risk tolerance? And then you answer some questions, say, okay, you're pretty risk, averse, or you're a risk taker, whatever. And as you go through life later on, you should be less and less risky with your retirement money. But any kind of money that you invest, that's what you're trying to look at. So right now, I'd be very, very, very risk averse because I'm so old. I'm kidding. Okay, so here's a concept check. Here we have a creature. I don't really come up with names. Purchased 200,000 worth of Roman stock, received 4 quarterly dividends of $1,000 each, and sold Troman shares for $206,000 after 1 year. What is the rate of return? We need to consider both our dividends as well as our shares, share price, how it increased or decreased. It could be a decrease. And so we're going to add together the 6,000 that we increased. And it says we received 4 quarterly dividends of 1,000. So that's 4,000. Add those together, divide by our initial investment of 200,000. And let's find out what the answer is. C, 5%. Okay, so you see here at the bottom of the screen, we take our dividends, like I said, added it to our share price appreciation, divided by 200,000. That result is 5%. Okay. So let's look at something here that's going to talk about the risk, okay, that we're going to invest. So we have $10,000 that we can invest in, let's see, it says in savings account insured by the US government that will generate 5% rate of return. Yeah, right. You're doing a CD if you're doing that because there's no savings account that's going to get you that. Maybe that's what they're talking about. Or we can invest $10,000 in a profit-oriented company, okay? So if we have something that is insured and guaranteed by the US government, all right, that's the, I want to say RFID. Why can't I remember it now? Anyway, there's an insurance basically company that if a bank goes into default, goes into receivership, they get all the banking information and pay off everybody. It was up to $100,000 last I checked, but I confess I haven't checked in probably a decade. I don't know if it's gone up or not. It should have, based on time value of money that we'll get into in this course. But you either do that where it's basically pretty much safe, or you trade off the easy risk and the 5% for hopefully something better if you're investing in a profit-oriented company that could go under and you can end up with nothing. So that's the trade-off you got to look at. Which one do you want to do it? And so in this case, this says that most investors would invest in a profit-oriented company only if the potential return is high enough. We'd have to figure that out, okay? Primary objective of financial accounting, again, it's going to be the amounts of our information, the timing of it, and the relative uncertainty. And that's really the uncertainty is something we haven't really addressed in the prior chapters or the prior courses of accounting so far. We're going to be starting to incorporate uncertainty, and that's kind of where this course becomes a bit of a challenge for some students. But if we can keep that in our mind that, hey, things aren't always certain. So we have to keep, when we keep that in mind and we get some guidelines, we'll be able to make these decisions and you'll do awesome. Cash versus accrual basis accounting. I really don't even like going into cash basis. You guys should already know this information about a cash basis. It's what you live every day. Accrual basis is what I've taught you in accounting 111, 112, 212, 219. All of these are accrual basis. That's what we're focusing on. I'm not getting into the difference between the two. You'll have some time doing that when you're in your tax classes because you have to adjust between some of those during your tax classes, but I'm not going into that. But I wish the following is not an advantage of accrual accounting. Spreads out the influence of one-time events that affect multiple reporting periods. No, that's accrual accounting. Highlights cash effects of operations. Not so much. We do have the cash flow statement, but that's again showing that the cash flow statement is showing what would happen, what would we look like if we were cash basis. Captures long run performance. Yeah, that's accrual accounting, and recognizes assets and liabilities associated with receivables and payables. The receivables and payables are accrual accounting. So I'm gonna have to say the answer is B on this one. Let's see if we're right. Yep. Okay. So highlights cash effects of operation. We're really not doing that for the most part. I mean, like I said in the cash flow statement, we do, but it's not a big deal. Lately, a lot of investors are asking about information about what people are doing for environmental, social, and governance. This is actually a very dangerous, in my opinion, place to be going into, as certain groups in society have decided that certain things are more important than, say, people's lives. Worrying about stuff like this can, I'm not saying environmental so much as I am social. Governance, I'm gonna be honest, I really have no idea on this one what they're talking about for governance. If they're talking about politically, again, every company, in my opinion, should be completely apolitical. There should be no, in my opinion, again, it's not reality, but corporations should stay out of governance, should stay out of the government. I get that government makes decisions that impact them. I still don't like it. You know, if they want to do a campaign to influence employees and people, stakeholders to vote a certain way, fine. If they want the voters to influence politicians, fine. I don't like their direct contact with them, but I digress. Sorry about that. But anyway, yes, they should be focused on environmental control. They shouldn't be polluting things. That's a very important thing. But investors are starting to want more information on this, and um, as long as, I mean, they can. As far as I know, there's no SEC requirements that they have to. But if more and more investors are asking for it, then they might just naturally glide into that. But we'll see how things go. What they have a think, if I'm not mistaken, at least I've heard that they're talking about it, but there's a social credit check in China, like how well do you toe the line with the government, kind of a thing. And that's kind of what I'm worried, that this social and governance kind of thing is, you'll start getting more credit checks than just your money, which I kind of get the money. It helps mitigate some of that risk in investing. But when you start saying, well, you're not socially worthy because you voted a certain way or you've done something that we don't like in this group, then that's pretty jacked up. So okay, let's move on. Let's get out. I really hate politics, but I see it seeping into the accounting world a little bit more lately. Not much, but a little. All right, you should know what GAAP stands for. GAAP is the generally accepted accounting principles. It is our guidelines. We are not so much a rules base. We do have a lot of rules essentially, but we want to make sure that we're guiding more than we're saying this is absolute. When we do absolute and we say this is how it is, then it makes people, accountants specifically, make decisions that they actually might think would not be in the best interest of the investors. And what we're going to be talking about in this course is that there's going to be times when we deviate from generally accepted accounting principles, because if we didn't, it would mislead our investors or our creditors. So sometimes that has to happen. Here's the breakdown. I mean, this isn't something I necessarily really care about. I mean, I came into you know APB. I wasn't alive when they made when the APB kind of ended, but FASB was, and they still dealt a lot with the APB pronouncements and things like that. So there was a hierarchy of standard authority setting, like it says. This reflects more. If they didn't have cap and APB, then it's more likely what everybody here has seen as a result of the Sarbanes-Oxley Act. We have the Congress, the SEC, the private sector, which is essentially the FASB. And then as a part of the SEC, you have the PCAOB, which is public. Yeah, I'm sure it's in here. I can't remember what it stands for. I've never dealt with them, so hopefully we'll deal with them. Okay, let's talk about the SEC and two different acts that kind of created the SEC and gave them their power. So it was created in the SEC because of the stock market crash. If you guys remember the Great Depression and everything, So a lot of things happened in 1929. Obviously, Black Friday was that October 13th, I think it was, or something like that. What they want to do is the government wanted to restore investor confidence, which obviously that's what they were going for. But during that time, as you may be aware, I'm not sure, there wasn't a whole lot of social media going around right there. Primarily, people focused on newspapers and other things like that. So getting information out then was pretty slow. And as a result, you had a lot of people who were doing nefarious things, causing a lot of problems. Therefore, they created the 1933 and 1934 Securities Acts, um, basically making it to where you could not sell securities and things in a bad way. So the Securities of 1933 Act focused on initial offerings in the stocks and bonds, and the 34 stretched those out to the secondary markets and things like that. Bottom line is you have to be registered to be able to do certain things with securities. If you don't, and if you are caught, then you can be arrested and dealt with, not jailed, but basically, prosecuted. That's the word I was looking for. Based on these acts, they're still around. They still influence us greatly today. Okay, so the accounting procedure, the Committee on Accounting Procedure. Okay, this history stuff's good to know. Just know it, I guess. Just be aware of it. I don't necessarily care a whole lot. It's important for us to know where we came from. My focus is though is on the more recent future for this course. We did have the Accounting Principles Board, which relieved the Committee on Accounting Procedures duties. Things evolve as far as their needs, and so once the accounting procedures have really been set, okay, we don't need procedures. Let's change it to the Accounting Principles Board, and we're focusing more on accounting principles and how to do that. Then in 73, FASB was created to support the Financial Accounting Foundation. 7 whole full-time members at the time, and it's grown since then. You have GASB, which is the Government Accounting Standards Board. All right. GASB does the government standards for what they do. I dealt with GASB a little bit when I worked for the Auditor General. We did a lot of government entities. That was our primary focus. Emerging Issues Task Force was created in 1984. Haven't really dealt a whole lot with them that I know of, but I'm sure they helped the FASB out a lot. So anyway, let's move on. Let's see here. Accounting standards in the United States are currently set by, it's the FASB, AICPA, NCAA. Come on, that's the freaking college football and organizations. EITF, was that one of the ones back here? EITF, okay, Emerging Issues Task Force. No, it's FASB. It's FASB, there it is. Okay, so this is something that is very important to us in this class. You are going to be doing several codification assignments. It's not every chapter, but pretty darn close. I think there's only 2 that you don't do a accounting standards on. It used to be that we had to go through all these different pronouncements, all these different court cases and things like that established standard. It was a mess. Okay, I just hated it. Whenever I had to do homework, okay, this is what's going on and this is what's happening. Look at it. Oh, I hated it. Oh, I hated it so bad. Then they decided to start talking about a codification where they basically took all of these pronouncements and rules, and because sometimes you'd have lower authority say one thing and higher authority contradict that. And so it got confusing. It's just like our court system today. Some lower courts will say you can't do that, and then the higher courts say no, you can't do that. Lower courts, they can do that, and so it's just kind of a mess. Except we didn't. I don't know. We really didn't have a way to purge the lower court stuff. I don't know. Maybe they did. I didn't notice it. Bottom line was, we came up with the accounting standards update, or the codification is what we call it. Call it the ASC, the accounting standards codification. It is beautiful because they put everything together in big groups, and everything you want to find about those topics, like on this table I'm showing you here, is there. Okay, it is beautiful. It is nice. You can look it up, and going back a slide, located at the FASB website. It's just www.fasb.com or gov. Is it com or gov? Oh, let's find out. I click on this. And it is .org, none of the above, right? Okay, so it's org. So you come over here and you can click on these accounting standards. Codification used to be we had to pay for it. Now we don't, thankfully. So click I'm not a robot, click access, click that you agree. I never read this, so I'm not encouraging you not to read it, but I've never read it. I got way too much to do than that. You can look stuff up by category. It's really cool. Right? Okay, general principles, overall status, and you go through all these things here. Presentation, let's look at assets, liabilities. You know, it's really kind of a cool situation. Cool situation. Oh, I hope you guys haven't seen that. There's like a little square right there. Let's move it. Anyway, so go to that website, especially when you're doing your ASC assignments, the accounting standards codification assignments. And I'm planning on doing a video just on how to do that and to kind of talk about it a little bit. So hopefully that will help you guys. International standard setting. I do not give a rat's about what the rest of the world is doing. I only care about the United States. I can't stand the IFRS. I can't stand the IASB. Don't care. Won't give you questions on it. If somehow one of them leaks through, please let me know. I will be more than happy to give you credit and not take it away from you. If you feel so inclined, I took a class solely devoted to IFRS, hated it. If you want to look at this and you want to go over it and understand it because you want to just know the difference, knock yourself out. I'm not going to ask you to do that. Okay. We used to be trying to converge, and it was the worst idea anyone can ever come up with. It's like you have these two very different, I'm trying to think of a good example. It's like trying to get McDonald's and Microsoft to merge. Like, what are you doing? Theirs was completely different than ours. Their approach is completely different ours. They are more loosey goosey, and we were more locked down as far as things that you could and couldn't do. So, bottom line is the convergence ended. I don't like it as well. It appears likely that FASB and IASB will continue to work together to converge where possible. Some differences will remain. I don't see us converging at all with them anymore. It's basically at this point, it's you one gets rid of the other if it happens. And I doubt any of these other countries are going to take US GAAP. And I pray we don't chicken out and take IFRS because it's no. Environmental, social, and government standards. Again, I'm not giving you a whole lot. I'm not giving you any questions on these concepts. Know them as something that maybe is important to some people, but you're going to notice that IFRS and other foreign governments, it's something that those groups have agreed on. You know, we don't. I won't say we don't care, but we have a different approach, and we're not really dealing a whole lot with that. Not requiring certain things. Here's a standing string. Some of this stuff is like, dude, just gouge me out an eye or something. Don't care about international. Okay, role of the auditor. Role of the auditor is to give an opinion. That is it. It is not a guarantee or a hard case. This is how it is. Okay. An opinion on financial statements saying, hey, we think based on our review, which is limited, but pretty thorough, that these are presented fairly and clear of material misstatements. Or, hey, these guys are jacked up, run the other way. You could do it either way, and I'm just giving you in layman's terms, but there's different types of ways that they would give their reports. So bottom line, that's their whole point. That's what auditors do. This is the Sarbanes-Oxley Act. I talked a little bit about it a few seconds ago. But these companies really effed things up. I don't know how else to say it. Enron was the big kind of in the face. WorldCom was the secondary, but Xerox was right there as well as these other two companies that you probably didn't hear about. Bottom line is one of the big four or the five at the time, auditing firms decided to give advice to mainly Enron and WorldCom and these other companies, but also audited their own work, which wasn't something that was a good idea. And at the time, we were extremely rules based, and it was no specific rule that said you couldn't do that. And so they said, hey, we can do it, even though it makes no sense. It's like me saying, okay, you guys do your book report. I'll never make you do a book report, but if your teacher says do your book report and then give yourself a grade. If anyone gives lower than an A, what's wrong with you? I don't know why you would. I mean, I'd give them. You're going to tell me that I can give myself my own grade. I'm not even going to hope and do it. I'm going to get an A. You know what I'm saying? I mean, just because that's what I'm here for. I'm supposed to do that. I'm supposed to say what grade you get based on data and information. So as a result, we moved away from rules based and we're focusing more on principles. Instead of saying you can't do X, Y, and Z, we say you better not do anything that involves something like, or not even something like that, but basically you better not do anything that's going to screw up the accounting profession. And I'll tell you what, the whole Arthur Andersen thing screwed up the profession for a good long time. We have codes of ethics. Every 2 years, I got to do a code of ethics course as a CPA and to maintain my certification. Okay. And it's, pretty obvious in some areas, but a lot of it deals with our structure in accounting as far as what our ethics are. It's not like, you find a purse, what do you do with it? That's, there may be like one question like that, but most of them are like, if you have a question about this situation, where do you go look it up? So, but anyway, if you need steps on how to make ethical decisions, notice we're focusing a lot more on ethics in this course. Okay, we are, because at this point we figure you're going to be an accountant, or at least pretty heavily involved with accounting, and so we need you to make sure you're not going to screw things up. I don't know how to describe that. I'm sorry, don't screw things up. Um, Bottom line is, I mean, I'll let you, I don't want to read all of these, but bottom line is you just need to take these steps. What's going on? What are the alternatives? How is this going to be perceived? How is this going to actually hit? So, for example, when I was at the Auditor General's office, we had I couldn't, well, let me say this. We audited community colleges. Well, an opportunity came up for me to start adjunct teaching at a community college. And my opinion was, well, I'm not auditing those community colleges. I was in a completely different area. It had nothing to do with it. I'm not even teaching. I was going to teach fraud accounting, which isn't even something that's auditable. You don't audit fraud. I mean, fraud audits sometimes find fraud, not as much as you might think, but that's something that you can do. I thought, hey, rules based, I should be able to do this, no problem. But my auditor general at the time said no, because we have to avoid even the appearance of that word just leave my brain. Of independence. We had to make sure that we didn't even give any possible view that we were at all doing work and then auditing that work. And that's one of the things that we had to go through in this and evaluate. So I ended up quitting that job and got another job and did adjuncts. I really wanted to do that, and I'm glad I did, because here I am. So yeah, okay, just make sure your stuff's quality, make sure it's timely, all this other stuff like that. Oh, this is a question. Which of the following is not one of the ways in which high quality accounting is encouraged by the U.S. financial reporting system? Accounting standards encourage comparability. Absolutely do. Auditors assess whether financial statements are materially misstated. That is correct. We're there as auditors. I used to be an auditor, not of financial statements, but anyway. Are the financial statements materially misstated? If not, we're good. There could be some stupid minor things in there, but it's not going to impact a decision maker. Sarbanes-Oxley instituted reforms designed to improve the quality of financial reporting. Absolutely, that was one of the whole purposes of that. So I'm guessing D is it. Managers are required to use frameworks for ethical decision making when deciding how to account transactions. They're not required to. They dang well better. They should use them, but they don't. They're not like someone's. Yep, there it is. D. They're not like being forced to, but it would be a good idea if they did. So, all right, conceptual framework. We covered this briefly in Accounting 111. We have our standards, our conceptual framework, our principles, assumptions, and constraints. So let's go through some of these. We have our objective elements. Financial statements is where we're going. Our characteristics, recognition, our principles. everything goes into the financial statement so that we can do that. So if for some reason you need the alternative for this slide images, there's a selection here at the bottom to link to do that. I don't care about IFRS, so we're moving past IFRS. Should just take these out. I didn't know why I didn't do that. All right, well, let's just do this question. Which of the following is not a component of relevance as defined by the FASB's conceptual framework? Free from error. Yeah. Because materiality is not. Predictive value is, and conformity value is, I think it's A. Free from error. There we go. Okay. Which of the following is not a component? Free from error is a component of faithful reputation, representation. That's right. And these are the things I should have maybe stayed a little longer on this one, because you see here the decision usefulness. Is it relevant or is it has a faithful representation? And then that's where you go down here. So this is a lot of the theory kind of behind why we do certain things. This is the stuff you should keep in the back of your mind as we do all of our assignments. It's not something that you need to keep in the foremost of your mind. It's not a calculatable thing. This is the guidance that you want to use to make decisions. So in this case, which of the following is not a component of faithful representation as defined by the FASB's conceptual framework? Free from error. Well, that one we just knew is. Then we have neutrality, understandability, and completeness. Let's just go back over here. Understanding, neutrality, and complete. Look at that. Faithful representation, completeness, neutrality, free from error. I didn't know if I saw that other one over here anyway. Oh, relevance. Is that what the other one was? Oh, neutrality was there. Understandability. Okay. So that's kind of what we're looking at with these questions. So I'm guessing it's understandable. Yep, there it is. Understanding is an enhanced characteristic of decision usefulness. Okay. And then we have our elements of our conceptual framework, and this is going to be pretty much your accounts that we deal with. Okay. All right, underlying assumptions. All right, we have our economic entity, going concern, periodicity. I don't know if I'm saying that right. And monetary unit. These are our assumptions. Okay. Should be very familiar with these if you've taken my classes. If not, pause the video here and read up on them. Okay. Now we have our principles, revenue recognition, measurement, and disclosure. All right. You know what? Recognition. They just call it recognition now. These are the categories, I guess. I've never seen it. I don't know why I didn't think of that when I was looking at these. Revenue recognition and expense recognition. That's what I was like. That's why I was like blowing my mind here. Revenue recognition, expense recognition are what we're looking at here. Basically, when to recognize revenues. And if you take it again, I'm gonna stop saying that. If you're taking my class, if you're taking any class, and you have since you're here, when you recognize stuff is when it's going to be either included as a revenue or an expense. Okay, revenues if you've earned it, if you have reasonable, accessible, lawful means of access to that, whatever it is you've earned. Okay, and then expense recognition is, basically not stop singing. Got to be in the period that you used it. It is associated with the revenue. Anyway, different approaches. I'm just kind of glancing through these because this was when I went through the stuff. I was thinking of some of this. Measurement. Okay, so we have historical cost, net realizable value. That's a new one for you. We didn't really talk a lot about net realizable value in your other courses, I'm guessing. I know in mine I didn't. We're going to go over that in this class. And then current cost, present value, and fair value. You should be familiar with those concepts as well. Historical cost is going to be for assets and liabilities and long-term assets. Net realizable value, current cost, and present value. Net realizable value is basically whatever you can sell something for the net, or the expense related to the as much as you can sell. Let me lower of cost or market is a type of net realizable value. But when you have a lower of cost, your lower is market. In other words, your asset has devalued to the point where you're not going to sell it for any kind of profit. Well, you still may have to do other things to get it to sell, and therefore you have to consider those other options into that calculation to find out what the actual value is for that asset. Okay. Again, we're going to go through this in our chapters. Just know that net realizable value is a type of lower of market. Current cost is basically whatever, if you were to rebuy the asset today, you could also call it replacement cost. Either way, whatever it costs to buy that car, or that, if I'm thinking cars, because cars have that as a thing. I own a Toyota truck. I get hit and it's totaled. I don't get the full amount for that truck, even though I should, in my opinion. They don't. I don't get it, right? Because it's how insurances work, and they suck, and I hate them. But you get, if I had car replacement, that's what they're saying. Well, we'll buy you basically the same or better car that you had. Like, so if it was a 2014, which it is, with 200,000 miles, which it isn't, we'll find you something pretty close to that. And then present value is basically whatever the value of it is in today's dollars. Fair value, whenever you trade something or buy something or get something, you're doing that. We assume it's fair value, and if it's not, we have to account for it. We can look at it: market approach, income approach, and cost approach, which I've done some analysis on this. It's kind of an interesting thing to go through, but it's not. It's a little bit more involved. I'll give you that. All right. Which of the following is not a measurement attribute defined in the FASB's conceptual framework? Well, we look here and we see net realizable value. Yeah, we went a little bit over that. Historical cost, absolutely. List price. What is that even? List price. That sounds like a realtor's list price of the houses. Well, it's not necessarily what the market's going to bear, right? It could be more, it could be less. Fair value. So I'm guessing list price. That just feels wrong. There we go. Yeah, it's whatever the seller indicates, but if it's negotiable, then moves on. So, all right, let's see what's next. Oh yeah, fair value hierarchy. Okay, so if it's a quoted market price, you have it in active markets, then it's the most desirable. That's what you would use if you're doing something at fair value. If you don't have a market for it, okay, you have to figure out other observable inputs. In chapter 10, we're going to talk about that. We're actually not going to be in chapter 12 as what the most desirable one is, the quoted market price. That's what you get in accounting. If you're in the more Maricopa community colleges, it's accounting 220, and it's intermediate accounting 2. Either way, it's going to be an intermediate accounting 2 wherever you take that out. And then the least desirable is anything that you're pretty much, you can read it again. It's basically your best guess. Okay. It's still better than nothing, but we want to make sure that we're as high up on that fair value hierarchy as possible. Which the following is not true. Fair value hierarchy reflects the subjectivity of inputs used to compute fair values. Subjectivity? Yeah, I could see that's probably true. Level 1 of the fair value hierarchy refers to quoted market price. Yes, we just talked about that. Level 3 is the fair value hierarchy refers to inputs that are not directly observable. Yeah, I'll go back and you can see that right here where it says unobservable inputs. That was number 3, so that's definitely correct. So D again, I'm guessing level 3 inputs are preferred. No, it's the other way around. It's the other way around. There it is. Sweet. Okay. Fair value options, it's going, in some instances, going to give you ability to relate the costs of the assets or the liabilities so that they're at the fair value, if that is what FASB or the accounting standard says we have to do. Maybe before, and again, I don't know for sure because I'm not a standard guru as far as someone that's like done all this research on it. But let's say before it says that you need to report X asset at fair value using only the number 1 that it gave. You have to have some kind of market for it. And then, okay, well, what do I do if it's not available? Do I write it off? What do I do? And so that's why we have these options. And that's why a lot of these other things that we're kind of saying, hey, just here's what you should look for. Try and find this, but if not this, then this. If not this, then pretty much give us your best guess. but indicate. And that's the other thing about disclosing things and letting people know, hey, this is what we're doing, and this is why we're doing it. It's because of X, Y, and Z. And that way, investors and creditors can say, okay, we get what you're coming from. Thank you for letting us know this is what you think. Now we can take that information and make our decision based on it. It's not like we're trying to hide stuff or make things bad or whatever. It's just we're trying to do the best that we can. And here I'm remembering now that I want to make sure we do the word that you're going to need to enter into the professor video. I don't remember what I call it. The place where you go and you put the word in and say that show that you watch it. Our word today is Oregon, not the country, not Oregon, or Oregon. Sorry, I can't even say it right. It's Oregon, Organ, Oregon, like you're playing an organ, or my heart is an organ, Organ. For those of you who like the phonetic alphabet, Oscar, Romeo, Golf, Alpha, November. Okay, all right, Oregon. Oregon, not Oregon, not the state. Your heart, your liver. Actually, is liver an organ? I think it is. As I said about disclosure, here we are back in disclosure. Remember? All right. So one of the things that we kind of helped you understand, hopefully by now, is that there's notes to the financial statements. And we're going to deal a lot with those financial statement notes because, again, we have to disclose certain things. We need to make sure that our investors and our creditors know exactly what we're doing. And sadly, our competitors are going to know too, but we can't help that. If we're going to be public and trade our stock publicly, our information's public too. Even our competition will. But the good news is our competition will also let us know how they're doing as well. Supplemental schedules and tables are another way of doing it. Parenthetical comments. It's just kind of showing you some of the options you can use. Summary of recognition, measurement, disclosure concepts. You can pause this. It's the same thing we just went over. It's a summary chart. No, for our exams and things, I often let you guys use certain amounts of notes, usually 1 page at the most. But now's a good time to kind of be writing some of these little chunky things down as you study. Again, I don't know. Maybe I will, maybe I won't, but I might have some of these like, what's the fair market value hierarchy of, like basically, generally speaking, what is that as far as like, whatever, maybe. But most importantly, I'm going to be asking you questions like, hey, this situation has occurred. How do you recognize the revenue? Well, you might want to have this information. General criteria. Does it meet the definition of an element? Is it measurable and has relevant measurement attribute? Can be represented faithfully? Well, if those things all are met, plus other things about in each situation, boom, you have it. So definitely something to think about as you start now. Start writing notes as you go through these videos, as you do your homework and stuff like that. So evolving generally accepting accounting principles. Again, we're researching out of the 2025 book. Okay. Things change all the time. So if something may have changed recently, I'll definitely, if I catch wind of it, let you know. Our focus though will be on whatever the book is, and we don't ever want to even though it might be technically wrong now, hopefully I'll be able to remove some of those questions if you find it. So maybe I better not say that because I've had that bite me in the butt. But if you find something that has changed, I am prone to giving let's say that in that we no longer observe losses, unrealized losses on the balance sheet. We've moved them all to the income statement, which would be weird if they did. But let's say that change happens and I still have a problem. If you catch that and you let me know because you're in tune as to what's going on in the accounting world, then boom, dilly boom, I'll strongly recommend some extra credit for that. Hell yeah, heck yes. I didn't say a bad word. All right, recognize asset liability approach. Okay, so that was the revenue expense approach I was talking about there, I guess. Recognize and measure the asset liabilities that exist at the balance sheet date. Okay, so things like that. Definitely different things that could change how we focus on things. Okay. All right. Well, that's it. Yay. Okay. So remember to write the word down I gave you in that quiz that I was talking about, and we will see you in chapter 2, if not sooner. Let me know if you have any questions. We'll be happy to go over them. Take care, everybody.